Hey, it's Tom here, and Merry Christmas. For those watching in New Zealand and Australia, down under, it should be Christmas by the time this video is going live, and it's at least going to be getting pretty close to Christmas for our Northern Hemisphere viewers as well. So I put up a community post here on YouTube for a Christmas Q&A special just yesterday, and in this video, let's basically start working through some of those questions. Alright, so the first question we have here is from CJ Wilson. Any plans to get Mohnish on the podcast? Happy holidays, Tom. Yo, it's the Bitcoin bro. Bro, what are you always doing in here? You gotta come fishing with me. I just bought a boat. How on earth did you afford a boat? I thought you were broke. What do you mean, how'd I buy a boat? Did you not listen to me in April? I said we're going all in Doge, 3 reasons. Dogs, memes, and diamond hands. We pump, we dump, and then we buy a boat. You know what, I actually think I heard Warren Buffett say that one time. Look, I don't know why you're still listening to that guy, but whatever, man, I'll go fishing by myself. Alright, sorry about the interruption there. As much as I would like to go fishing with Bitcoin Bro, we had better get to some of these questions. So let's have another go at CJ's question with the first one. CJ Wilson, any plans to have Mohnish on the podcast? Happy holidays, Tom. That would be the dream, but I have nothing in the works that I'm hiding away there or anything like that. Yeah, would love to have that happen one day, but no plans or nothing scheduled or anything at this stage. Next one is from Matt R. How do you think about portfolio weightings at cost, and do you average up/down? So this is an interesting one. I think I would probably have a more structured approach on portfolio weightings and so on if I was managing a fixed kind of pool of capital, a fixed amount of money. It's a little bit more difficult to sort of follow strict rules when you've still got new money coming in and so on. So for me, my annual savings still really do move the needle in terms of my portfolio. So if I were to put on a 10% position in the portfolio at cost, the annual savings would dilute that down over time relatively quickly still. Yeah, I'm not quite as structured as you maybe could be. I don't think I would like to have anything less than maybe 5 stocks in the portfolio. That's probably about reaching the sort of limit of how concentrated I would want to be. And I don't know that I'd want to be more diversified than maybe 10 or 12 stocks. After a certain point, it just really becomes difficult to kind of keep up with the companies and still continue to follow them really closely and have enough time to kind of think through them all in good depth. So that's kind of how I think about it. I tend to weight things roughly equal weighted. Sometimes I'll go a little bit heavier into something if I have more conviction, and sometimes if I have a little lower level of conviction, I'll make it a half position or maybe even kind of smaller than that. So that's kind of how I think through that generally, at least. And in terms of averaging up and down, more than comfortable to do that. I find it kind of mentally easier to average down generally, but I have averaged up on stocks before as well, and I'm getting a bit better at that over time. So I appreciate your question. Next one from Samson. I don't think this is a question, but he says, Merry Christmas, Buffett and Tom. Merry Christmas to you, Samson. Next one is from Krista. Do you have anything new on your watch list these days? Greetings all the way from Norway. Appreciate you watching. There's been a couple of things I'm looking at. I'm really studying actually seriated growth properties. Kind of again, I'm doing sort of another deep dive on that. It's already in the portfolio, but I'm sort of going through the process of revaluing that at the moment. And Thor Industries actually is one that I've owned for a few years now, but that's actually come down quite significantly. I don't think it's quite at the price where I would buy it, but that's one I'm kind of keeping an eye on. So yeah, not a whole lot of new stocks that I've been looking at. There was a very, very small cap, like nano cap, oyster company actually in Australia I was looking at for a short time. I may leave it to Neil, the adventurous investor, to make a video on that if you're watching, Neil, because he's got an interesting story with that one, but that's all I will disclose for now. So thanks for your question. Next one is from Tom. I was just wondering if you were planning on allocating any capital to Prosus/Tencent now that Mohnish's stance has been officially revealed. What would be your rough target percentage if you were to get amongst it? Yeah, so really no plans to add to Prosus or Tencent at the moment. It's of interest. I have a reasonably substantial Alibaba position, so I do have some concerns about getting overly concentrated into Chinese stocks. I would be open after maybe some more study on Prosus and Tencent to potentially sell some Alibaba to buy Prosus. I thought that was more attractive, but I'm pretty comfortable with the Alibaba position, and Alibaba is kind of complicated enough. So I initially, when I was looking at the Chinese stocks generally, I was thinking maybe I'll make some sort of basket bet because I think it's kind of cheap generally. I've switched my approach on that sort of when I made the Baba investment, and now sort of the thinking that I should really just hone in and focus on understanding one of those companies as deeply as possible, because they are quite complicated, some of them. So for now, I'm just kind of sticking to solely the Alibaba position. But it was really nice to get some of the things that we'd speculated about as to why Mohnish might have sold Alibaba. One of the theories being tax loss harvesting and going on and buying Prosus. That was kind of confirmed. So that was great to see. And big shout out to the Everything Money guys. If you haven't seen the sort of interview they did with Mohnish Pabrai, that's where all of this stuff was revealed. I don't watch all of the Everything Money content by any means, but those guys crushed it, did a great job. And yeah, really impressed with how they were able to get Mohnish Pabrai to open up as much as he did. He often doesn't talk about a lot of his actual holdings in his portfolio and what he's buying and selling with any level of detail until he's kind of completely out of the investment. So great to get some info on that. So thanks for your question, Tom. Next one is from Luca. When you studied ASOS, did you take a look at its closest competitor, Boohoo, that has higher growth, better margins, and seems more undervalued? Any thoughts on it? I really haven't had a close look at Boohoo, but I know, Nick Sleep's partner Zach, I think, may have an investment in Boohoo. You may want to fact check that, but I think that is the case. And the margins one is an interesting comment, because the whole Nick Sleep approach has really been the scale economy shared model. So you would kind of counterintuitively actually think that lower margins is maybe better, because they're able to pass those cost savings onto the customer in order to grow the pie bigger. So I would kind of have to do some digging on how Boohoo is achieving those higher margins, whether they have some fundamental cost advantage or whether they're just charging higher prices, and how that would impact their longer term growth rate, if they were trying to sort of charge a premium to ASOS products, for example. But haven't had a close look at it. I kind of just came to the conclusion with ASOS, at least at current prices, kind of when I looked at it, that it was just too difficult for me to understand. It's clearly an industry with a lot of tailwinds, online fashion, but it's really, really hard for me to try and figure out who might win that race. When you've got competitors like Amazon, at least in the US, and I know fashion is a little bit different to just kind of everything else that you might be buying on Amazon, but it was just really, really hard for me to try and figure out what kind of advantage ASOS did really have versus some of their competitors. Okay, next question is from Just One. Ali, no, I'm joking, great. How often do you reach out to the investor relations of the companies that you're researching and to the investor relations of competitors? Happy holidays, Tom. Thanks for your question, and happy holidays to yourself. I've reached out to 3 different investor relations departments for 3 different companies. I won't name and shame them here, but not one of them has ever got back to me, and that's actually something that's been really frustrating over time. So 2 of those companies, when I've reached out to them, I have been a shareholder in, and one of them I have not, but I've been, close to making an investment, and I was trying to clarify something that I felt was really important to my understanding of the business. And all of that was just like submitting forms online, asking questions, never heard back from any of those 3. So that is actually really frustrating. Maybe I could get on the phone with some of those people and figure that stuff out, but I don't know. I've had pretty bad experiences so far with investor relations. Maybe I need to try that again, or maybe I've just been unlucky with the companies that I've been reaching out to. But let me know down in the comments if you've had any luck actually reaching out to investor relations people. I know some people have spoken to them on the phone at various companies before, and often it's often tough because they're not able to obviously give away material information and so on. So they're quite kind of cautious about what they can tell you. But open to hearing other people's experiences on that one. Maybe they've had better experiences than I have with investor relation departments over time. Next one is from Gabriel. Mate, which sources do you use when gathering data around our world? Examples, how many Z vehicles are out there? How many people consume X product? How many times per day does someone Y? I feel it's quite challenging when coming up with total addressable markets for stock research, for instance. Happy holidays, and thanks for all the wisdom shared with us this year. Yeah, happy to do that, and appreciate the question. So, yeah, in terms of getting market research, often you'll just have to straight up pay for it, to be honest. I have been working through like these heritage growth properties comps at the moment, so to get comparable sales data on all their properties, I forked out a couple $100 to subscribe to a website called Creeksy, I think it is, to search up, basically, what have similar properties sold for, comparing those to what's in the SRG portfolio. And I think in the grand scheme, if you're investing enough money for, $200 to not be too meaningful in the grand scheme of how the heritage investment works out, I think that can make sense to just kind of pay up for it. There's a lot of industry research out there in almost every industry, so some of it's freely available, like I think for most of these types of questions, like how many vehicles of a certain type are out there, you can look up vehicle registration stats and so on. So I think some of it will be easy enough to find. For more niche industries, you may have to pay up for it, or for more localized stuff like real estate values, you may have to pay up for that data, or just look at what the company itself is reporting. Like with my Thor Industries investment, for example, they always produce market share stats, so they collect vehicle registration numbers and so on from industry partners, and then they go ahead and take that industry information and put it in their investor presentations and so on. So there's a few different ways you can find it. Probably depends on the industry a little bit though. Next question is from SC358. Any SHITCos, I don't know if I can say that on YouTube, I might get demonetized. Any SHITCos on your Santa list? There's a bunch of stuff, wish I had more cash and time. Yeah, certainly agree with the second half of that. There's a bunch of stuff out there, wish I had more cash and time. Yeah, it's kind of an interesting market to operate in. I feel like there's been a lot of stocks that have been hammered and are down quite a bit at the moment, but the indices kind of seem to be getting held up by a handful of stocks. So there's a few things that are of interest. Nothing is kind of hitting me over the head, and that is really my standard these days, to try and focus on just finding one or two things a year that really smack you over the head. So nothing springs to mind that I can really talk to, unfortunately, SC. So next one is from Smooth Modi. Do you have a DCF template spreadsheet that I can use for my valuations? Yes, if you just go to all the videos on my channel, filter by most popular, the first two will give you a DCF spreadsheet. I'd probably go for the second one with slightly fewer views. That's sort of the Mohnish discounted cash flow type approach. So that is where I would go for that one, but appreciate your question. After dinner investor, mate. Everyone's got the mate in the questions, especially after dinner investor. I think he's got 3 of these things here, right? So first one at least, mate, did you buy a house yet? Unfortunately, I didn't. That was one of our goals for 2021, but haven't been able to tick that off. Travel restrictions and things, the excuse that I'm going to for that. But yeah, prices are through the roof, which is making it kind of difficult for me to get really motivated to get that one across the line. But hopefully we can get that done relatively soon, maybe early next year. We'll have to see how that goes. I'll give After Dinner Investor a second one because he's asking the big questions here. So he said, mate, Thor Industries, how big a bet did you make and how did you find this idea? So yeah, it's kind of funny in terms of the position size with that one. This goes back to the earlier question on position sizing and averaging up and down and so on. So when I bought Thor, that was a 50% position at cost, and the reason it was a 50% position is because I had basically no money, and I had a reasonable level of conviction on Thor and put a big chunk of the portfolio into it. And even though it's gone up, it's come back quite a bit now, but I think I'm still up about 50% on that position, plus some dividend money and stuff. I think it's about a 20% position now. So that just kind of hopefully puts in context how much kind of new cash has come into the portfolio over the last couple of years. And in terms of how I found it, Hamish Hodder here on YouTube, he was talking pretty extensively about Thor. did some digging on it myself, came to reasonably similar conclusions, and that's how it kind of ended up in the portfolio. So yeah, that's how I got to know Thor. And interestingly, they've actually just released quite a big share buyback plan as well. They've just authorized share buybacks, which I was kind of fingers crossed they might flick that switch shortly, because they're getting to the scale now where big acquisitions that will move the needle are probably going to be harder to come by. So they issued a buyback authorization for I think about 4% of their shares outstanding. So that will be an interesting one to continue to follow. Okay, so next question is from Josh. Hey my guy, FIF tax in NZ. Are the rumours true you'd have to pay tax on unrealised capital gains, or is it just income from dividends? Yeah, I've got to be pretty careful what I say here. I'm not a tax professional. Reach out to a tax professional if you really are stuck on this. But the short answer to your question is yes, and it sucks. That's kind of my view on FIF tax. I'm hoping to get a podcast guest who knows this stuff inside out and can kind of talk through actual examples of that. So head over and subscribe to the Investing with Tom podcast channel if you haven't already, by the way. Trying to get that kind of up and running with a video version of the podcast. So that's usually the first link in the description. But yes, that's true. We basically, there's sort of two different FIF calculations, and you can alternate between them year to year, and whichever number is lower, you can kind of go with that one to have a smaller, tax obligation each year. But it's interesting, you can come into a March 2020, have a big crash down, and then have a big gain in the next year because you're sort of recovering out of that crash, and get taxed on a lot of unrealized capital gains when that happens. But there's no way to offset some of those gains from losses from the previous year with FIF tax. So I don't have the most positive view, frankly, of FIF tax in New Zealand, and I'm hoping that we get just a more traditional capital gains tax. Honestly, would be a preference for me, because I'm a long-term owner of businesses. I'm not trading in and out of them, so that would kind of be my preference. But on the flip side, in Australia and New Zealand, there's no comprehensive capital gains tax. We have dividend imputation credits. We can't claim the franking credits in Australia as New Zealand investors, as far as I know. But there are some great tax advantages in general for New Zealand investors versus most countries. But once you start investing internationally, with the exception of Australia, you can start to run into some much kind of curlier tax stuff. So thanks for the question, Josh. Question from Cloud Developer. What changes, if any, have you made to your overall investment philosophy over the last year or so? What ideas are you even more assured of now than before? Yeah, look, I don't think fundamentally much has really changed in my investment approach through 2021. I'm still trying to understand what a business is worth and try and pay a whole lot less than what I think the business is worth, basically. I have probably come to appreciate a little bit more, really good businesses. You tend to get good surprises from good businesses and bad surprises from bad businesses. And as much as I love a 50-cent dollar, I can start to see why a lot of investors have transitioned towards higher quality businesses over time, even if they have to pay up a little bit for them. So that's something that I think has probably been reinforced a little bit this year. And the other thing that has really been reinforced, particularly from starting the podcast and talking to some really good investors, is kind of just getting it, clear in my head that these are just normal people. And when we look at, say, the recent Mohnish interview, when he came out and said that he sold Alibaba for tax loss harvesting purposes, he bought Prosus, even though in interviews he'd said he found Tencent interesting through the Naspers lens. There were people here on YouTube, like on the Punch Card Investing channel, for example, where they were kind of interested to hear that because they thought maybe Prosus might be more interesting. And then you see these super investors come out, or you maybe talk to professional investors, and they think in a very similar way. And I think we should probably have more confidence as individual investors that we can think through a lot of these problems just as well as a professional investor. Obviously there's people that are on different levels, like Warren Buffett and Charlie Munger are just like savants of the investing world, and we're probably, most of us at least, are never going to get to that sort of intellectual level of understanding businesses and investment and so on. But I've been really reassured, frankly, that I think I can think through a lot of these problems just as well as a lot of professional investors, a lot of professional money managers. And I hope that doesn't come across as cocky or anything, but that's just what I think. Like, these are real people looking at the exact same information oftentimes that you are. They don't have like inside information, and a lot of them don't even talk to management sometimes. And I think that you can I think you can come to some pretty good conclusions and think through some of these businesses and investment problems just as well as a lot of pros. Okay, so next question is from J5T3R. Have you considered looking into Turkey's market at all? The currency has been inflated into oblivion, but some companies are solid, especially companies that have US dollars as a hedge. Yeah, I haven't looked deeply into this. I kind of take the Matt Peterson view because he has invested a fair bit in Turkey, that if you can buy businesses that earn their money in another currency, you basically get over that hurdle of currency devaluation and so on. So yeah, buy companies that earn US dollars or euros or something, and if you can find them in Turkey, you can buy really great businesses at much cheaper valuations than those same businesses would trade at in other countries, just because of all this macro stuff that you would think at some point would get ironed out, but we'll just kind of have to wait and see on that one. That's kind of the approach that I would be interested in taking, and maybe invest in businesses that do have a lot of pricing power or some protection against inflation, whether it's a strong brand or a Coke bottler or a real estate company or something like that. That's kind of the way I would personally think through it, I think. Okay, let's take one last question, and this one is from Miniline Carey. Thanks for the Q&A, no problem. How would you go about valuing a business that is not yet profitable? Are there different ways? Thanks. Yeah, there's different ways to value different companies. So, real estate, you might look at the net operating income for the business, or maybe a liquidation value. For longer term compounder type businesses, maybe it's a discounted cash flow type approach, and I guess all businesses are basically worth the sum of the present value of future cash flows. So if a business is losing money next year and the year after that and the year after that, but eventually it becomes profitable, you can still run those numbers through a DCF, and that will give you an output. So in terms of valuing those businesses, you have to have some sort of view on what the future cash flows will look like. Maybe maybe right now they're not producing any cash flow, but you think in a couple of years they will, and you just value it basically like any other business. You look at the present value of future cash flows. You maybe adjust for any cash they might have lying around or some debt obligations that they might have. The process is fairly similar mathematically, at least. The more tricky part really when you're valuing those businesses is to actually come to a level of conviction about how much cash they may produce in future. If a company is losing money at the moment and it's never made money, it can be difficult to have a high degree of certainty about how profitable they might be in future. But if you think you can get your head around it, then mathematically at least, calculate it the exact same way as any other business. Okay, so that's all we have time for this one. If you did ask a question, I really appreciate it. If you want to ask a question in a future Q&A video, just keep an eye on my community post page. That's where I always ask for the questions for these videos. But that's it from me for this one. I hope you all have a great Christmas and New Year and holiday period. Hopefully you all get to relax and have a little bit of time away from work and all that good stuff. So yeah, that's it from me for this one, and I'll see you in the next video. Cheers.